I mean, first off, let's talk about trade. Is the market overreacting a bit to the upside?
Well, the challenge for the market is that it also overreacted to the downside when, a lot of the trade war news started to happen. And so this is positive for the markets because it shows that maybe eventually there will be a light at the end of the tunnel. But as you say...
But we're still in the tunnel.
Yes, as you say, it is still very early. This is a 90-day truce. It does delay some of the tariff rises that would have happened at the beginning of the year. But, this is still only a 90-day period, so we'll have to see how it turns out.
What do we make overall, James, of a market that reacts like that to a couple of headlines?
Yeah, so the biggest challenge for the market, which this plays into, is where are earnings going from here? Corporate earnings have faced significant uncertainty over the last year or so because, 24% earnings growth rate for 2018. That's unsustainable going forward. So we should be happy about what earnings have done, but earnings are going to slow down. And so if you do get, boosts from trade, it looks like oil isn't going to help earnings, it starts to create a very murky picture, and that's really what investors should be focused on.
I'm glad you mentioned oil because now all of a sudden you've got this weird fourth quarter, right? We're in the fourth quarter. Companies have been trying to, deal with the tariffs. Now they don't know if there's going to be new tariffs, but their input costs, at least as far as crude oil, have likely come down. That, with the exception of the oil companies, is that just a net gain for earnings in the fourth quarter? Oil's drop?
So it is, but we're also coming off a slightly lower base than what we were a few years ago. So when oil started to plummet in 2014, oil prices were much higher. Oil was a much bigger part of the economy and the market. And so when it plummeted back then, it had a huge impact, both on the eventual gain to corporations, but also the direct impact where it hurt S&P 500 earnings. Now we're talking about a very different situation. Oil prices are falling, but it's not as big an impact as it was back then. So I think corporations and U.S. consumers will see somewhat of a bump, but that bump will take place over multiple quarters, and it's going to be a lot smaller than what we saw back then.
We still have the Federal Reserve, which is deleveraging and probably still raising rates in a couple of weeks at the December meeting. What do we do, James? Now we have all the news. The markets are going to be up big today. It looks like, anyway. It's futures. What do we do?
Yeah, so the point for the typical investor is to stay really balanced, not just in U.S. equities. We still like U.S. equities, but we're going to see lower returns than what we may have expected over the last few years. To be more balanced by holding potentially more fixed income. Rates are much higher now than they were even just a couple years ago. You can get much decent levels of income in your portfolio now. And also international stocks. International stocks have fallen out of favor this year. The story has gotten very difficult, but we still think that that's probably a great place to be.
International, the world maybe still looks a little better than us, a little bit behind us, a little more upside.
Don't be too overweight the U.S. relative to the rest of the world right now.